Welcome back to Investing Talk Podcast.
Today we're looking at NuScale.
As usual before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. For years, NuScale has really been a classic R&D firm, just, spending money to get those crucial regulatory approvals.
Right, a pre-commercial tech company.
Exactly. But now we are seeing a definitive shift in the financials. It's what I'd call a step function progression, a real move toward revenue.
A step function, I like that.
Yeah.
Because nuclear power, you always hear it's a decades-long game. But you're saying something just flipped.
It did. They're moving past the design and licensing phase into the really high-value work, the engineering, the construction prep.
Okay, so what does that look like in the numbers?
Look at Q3 2025. They reported roughly $8 to $9 million in revenue.
Which on its own doesn't sound like a huge number for this sector.
It's not, but you have to compare it. The prior year's quarterly figure was, around $475,000. So it's a massive jump, a material one.
Wow, okay. That's a huge increase year over year. And where's that coming from?
A lot of that initial momentum is driven by early work on the RoPower project in Romania. So you're getting that global validation right out of the gate.
But the big picture for 2025 is still, well, it's pretty ugly if you just glance at it. The operating expenses are huge.
Oh, they're massive. You're looking at a projection of about $547 million in OPEX against maybe $37 million in revenue for the full year?
And that $500 million operating loss is what scares off a lot of investors. It just screams risk.
It does, but you have to look a bit deeper. A lot of that was actually a big non-cash expense tied to securing their future contract pipeline. It's more of a one-off hit.
Okay, so what's the more critical number to look at?
For me, it's the gross margin, the potential profitability. We're talking about an estimated gross margin of around 66.8%.
66. Wait, 67% in heavy industry. That's almost unheard of.
Exactly. Infrastructure projects, they struggle to clear 10% sometimes. A number like that implies almost monopolistic unit economics once they actually get these things running at scale.
So the current losses are just the price of admission, the cost to get the license and build the factory, basically.
That's the thesis. It's not about poor long-term profitability, and that thesis all hinges on the contracts they're landing right now.
Which brings us to the really big one, the one with Entree One Energy and the Tennessee Valley Authority.
The landmark agreement. It's for up to 6 gigawatts of SMR capacity.
6 gigawatts, just to put that in perspective for everyone.
It's cited as the single largest SMR deployment program in U.S. history. This isn't just a study. It's a massive, multi-decade commitment from established utilities.
And what's so fascinating is the why behind it. This isn't just about replacing old power plants anymore, is it?
No, not at all. This is the critical shift. NuScale is becoming an AI play.
The power demands of data centers.
The insatiable power demands. And look, their tech was explicitly included in that $25 billion U.S.-Japan infrastructure framework. It directly links SMRs to AI power demand.
Because AI needs that 2047 carbon-free baseload power, something solar and wind just can't guarantee.
Precisely. So if this scaling thesis holds, and they go from about $43 million in revenue in 2025, what does 2026 look like?
The ramp is supposed to be huge. Analysts are forecasting an average of about $141 million for 2026.
Triple-digit growth. And that's the signal the market needs to see. It means those big projects are moving into higher value phases, and that operating loss will finally start to shrink.
Okay, all this potential is great, but big contracts need big capital. And that leads us straight to the company's biggest problem, the balance sheet.
The dilution dilemma. It's the core risk.
Let's break it down. On the surface, things look okay, right? For a company at this stage.
They do. They ended Q3 with over $750 million in total liquidity. It's very equity heavy, not a lot of long-term debt. That gives them some resilience for the long development cycle.
But resilience only lasts so long when you're burning cash this fast.
And that's the issue. Free cash flow is deeply negative. Around $200 million a year, give or take. All of that is being recycled into growth, R&D, licensing.
So that cushion is really more of a ticking clock.
It is. Which brings us to the single most critical event on the horizon, the one that everyone is watching.
The shareholder vote. This proposal to basically double the number of authorized shares from 332 million to 662 million.
It's a huge ask. And the reason they need it is because that 6 gigawatt pipeline is so massive, they need to show they have a clear path to capital to actually start building these things.
But the market reaction was, well, it was brutal. Investors see doubling the share count, and they run for the hills.
And you can't blame them. But in a capital-intensive field like this, raising money through equity is standard operating procedure. It was the timing and the sheer scale that spooked people.
And management really didn't pull any punches with their warning.
No, they were explicit. They said failure to pass this vote in December would, and I'm quoting here, raise substantial doubt about the company's ability to continue as a going concern.
That's serious language. It makes this vote a completely binary event.
It is. If they can't fund the pipeline, the whole growth story it collapses.
So how are they trying to soften the blow for shareholders? Voting yes to that kind of dilution is a tough pill to swallow.
They're planning to manage it through a new $750 million at-the-market offering program, an ATM program.
Can you explain how an ATM is different from just a big single stock offering?
Sure. So a big secondary offering, it usually tanks the stock price immediately because you're flooding the market with discounted shares all at once. An ATM is more flexible. It lets the company sell shares into the market gradually over time at the current market price.
A controlled bleed rather than a hemorrhage.
That's a good way to put it. It lets them raise cash when they need it, ideally timed with positive news flow, which is much less painful for existing shareholders.
Okay, let's switch gears. Let's talk about what's protecting the company through all this financial drama, their competitive moat.
It all comes down to their lead time, both on the technology and, more importantly, on the regulatory front.
And the key here is the NRC.
It's everything. NuScale is the only U.S. SMR developer with an NRC-approved light water reactor module, the only one.
Can you give us an analogy for just how big of a barrier to entry that NRC approval is?
Sure. Think of it like if everyone's designing a new airplane. NuScale is the only one that has full FAA certification to actually fly passengers commercially. Everyone else is still in the blueprint and testing phase.
And that certification process takes years and billions of dollars.
Exactly. It's a multi-year, multi-billion-dollar ordeal. It essentially gives them a license to be first to market in the U.S., which is a nearly insurmountable head start.
And that first mover status is perfectly timed for those AI tailwinds we mentioned.
Absolutely. The modular design is perfect for data centers. That's why you see validation from the Standard Power deal. They specifically chose NuScale for that reason. The U.S. Army's interest is another big tell.
Looking at the stock chart, though, the market is clearly torn. It's been incredibly volatile.
It has. We saw that big 20% plus drop after the earnings and the capital announcement, but then it staged a really sharp rebound, which tells me investors are seeing value in the low 20s, betting that this vote will pass.
And the analyst price targets still suggest a lot of upside.
They do. The average 12-month target is holding around $38 to $39.
Yeah.
From the low 20s, that's more than 100% upside. It suggests the market is heavily discounting the risk of this capital raise failing.
What about the big institutional players? Fluor has been a huge owner, but they're selling.
They are. And while a founding partner selling a massive stake can create an overhang, it's actually a healthy thing long term.
How so?
It broadens the shareholder base. It lets new funds, ones that specialize in energy and infrastructure, come in. It's a natural transition to becoming a widely held public company.
And is there enough short interest to fuel a rally if good news hits?
There is. It's sitting at around 13.7%. That's a significant number of traders betting against the company. If that December vote passes, that short interest could act like rocket fuel. A classic short squeeze.
We have to cover the bear case, though. What keeps the skeptics up at night?
Execution risk. It's always execution risk with projects this complex. Delays, cost overruns. They could chew through that cash reserve so much faster than planned.
And that's a real threat in the nuclear sector.
It's a constant threat. So the question isn't if the revenue will come, but when, and how much capital gets burned while they wait for it.
So for anyone following this story, the next 3 months are absolutely crucial. Let's lay out the calendar.
Okay, 3 key dates. Number 1, the big one. December 16th, 2025. That's the shareholder vote on the shares. It's make or break.
What's next after that?
Look toward mid-January, around January 15th, 2026. That's when the Fluor Equities sale program is expected to end. Getting that big block of shares off the market will reduce a lot of uncertainty.
And the third date?
Late January or early February 2026, that's the Q4 earnings update. Everyone will be looking for clarity on project timelines and, critically, how that new ATM capital raise is going.
Beyond those dates, what about the more speculative stuff, the potential game changers that aren't on the calendar yet?
Well, there's always chatter about more support from the Department of Energy. A big federal loan guarantee would change everything overnight. It would basically eliminate that capital risk.
And circling back to AI one last time.
That's the other one. The big prize would be a long-term power purchase agreement, a PPA, with a hyperscale cloud provider, a Microsoft, an Amazon, a Google. If they land one of those, it validates the entire thesis on a global stage.
So when you boil it all down, NuScale has solved the technology problem, and the demand problem seems to be solving itself thanks to AI. The whole story comes down to this one question.
It does. Can they successfully navigate this capital gap? Can they win that shareholder vote in December and turn this incredible 6-gigawatt pipeline into actual high-margin revenue? That's the whole game right now.
So the question for you to consider is this. Does this technology become the essential pickaxe in the AI gold rush? Or does the execution risk make it a cautionary tale? Remember to subscribe, like, and comment to ensure you don't miss our next analysis. We appreciate you tuning in to Investing Talk Podcast.